This is the Savvy Investor radio show and podcast with Mike Kinnett and Ryan Herbert of ProStatus Financial, now celebrating 20 years helping families build successful retirements and lasting family legacies. Mike is a financial planner and estate planning attorney with a master's degree in tax and 4-time Amazon best-selling author. Ryan is a 5-star Wealth Management Award winner and top-ranked financial advisor by Forbes. Now, the Savvy Investor radio show and podcast.
So we always talk about the market, the Dow reaching another historic milestone, the 40,000 barrier. So naturally we're thinking, hey, what should we be doing? I don't want to lose 20 to 30%. But how often does that actually happen? And this is the question that I want to ask the two of you, because we're going to talk about taxes here. And if you're a business owner, stay with us too, because we want to address your concerns as well. But I find this interesting, Mike, and Ryan, should we not worry about the market? Because how often does the market lose 20 to 30%? I got a bigger problem over here, man. I've got Uncle Sam. As soon as I go to retire, he's going to take 20 to 30% if I don't do anything. So do we worry about taxes? Do we worry about the market? Can we work on solving both those issues?
I mean, you have to worry about both because, you know, your question there, how often does the stock market lose 20 to 30%? Well, historically, every 7 years, we have a pullback in the market, and the average depth of that pullback, I think, is like 30, 35%, 34%, somewhere in that range. So, you know, if you think about it, if the stock market takes a 30% hit and then you're retiring, you need to take money out. So you've lost 30% of your money just on the stock market alone. And then when you go to take money out, you're losing 30% to taxes. So taxes happen every single year, whether you like it or not. And part of the unfortunate situation, one thing that I do see when people come in and they've already retired and they've created their own retirement plan, they know where the money's going to come from, and they calculate out their taxes, how much they're going to pay. And then when they go to do the taxes that very next year, when they're doing the taxes, they owe a lot more money than they thought they would. And what people aren't realizing is the compounding effect that these withdrawals can really have on your taxes. When they're thinking about, you know, here's how much tax I should take out on my 401k. I'm in the 22% tax bracket, so I'll take out 22% for the Fed, 7% for the state, and I'll be done with it. They're not thinking about the impact that money they're taking out of their 401k has on their Social Security. They might not have been paying tax on any of their Social Security. So then all of a sudden I'm taking out 50 grand from my 401k. It's triggering my Social Security to become taxable, but no longer am I in that 22% bracket. Now I'm in the 25% bracket. So now I'm paying 25% tax on my Social Security and 25% tax on my 401k. And I've really caused myself this massive, massive problem. And the advice that they got was, when they talked to their financial advisor, was, oh, well, people your age, we normally recommend you withhold 20% taxes on the Fed and 7% state, because at the very, very bottom of your investment account statements, when you're working with those big box stores, whether it's Vanguard or T. Rowe or Morgan Stanley or any of those companies, the very bottom of every single page of that statement says, talk to your tax advisor about your money. Ask them questions, because they don't give you tax advice. The biggest difference between Mike and myself and our team here at ProStatus is we take into account the tax considerations. When you're thinking about taking out those random withdrawals, or you're even planning your income in retirement, if we've planned out your income in retirement, one of the common questions we get, you know, hey, Ryan, I think I want to buy a car. I don't want to finance it. I want to take out $30,000. What should I do? Well, I'm going to sit down and look at all the various accounts that we have and figure out the best place to take the taxes from, because I'm not just concerned about the taxes on that $30,000. I'm concerned about the taxes on your entire tax return. That is the true benefit of having an advisor that thinks about the taxes. That's the true benefit of not only having a retirement plan, but having a tax plan that goes along with it. Sit down with Mike, myself, Lawrence, Catherine, Andrew, our team here at ProStatus, and we will put together your very own tax planning analysis, where we're going to talk about your taxes in retirement, but we're also going to talk about saving you money in taxes on retirement by doing Roth conversions and possibly getting you down to a 0% tax bracket.
Wait, did you just say 0% tax bracket? And if you call today, Ginsu knives.
Yeah, and a free toaster. You know, that 0% tax bracket it's not something we can do for everybody that comes in, but it does happen more than you think.
And here's what I want to add to that, Michael and Ryan, is that the fact is that people do worry about the Dow and the markets going up and down and how it's going to impact them. But the reality is you have no control whatsoever about market fluctuations. Now, you can control how much risk exposure you want to have. You can choose whether the income that you're going to receive during your retirement is exposed to the whims of the market, right? So you can choose to take that risk off the table, or you can choose to leave it there. You can choose to take the risk of your portfolio growing over time, or choose to take the risk of the portfolio dropping over time, right? And every 7 years, on average, like Ryan said, the market drops 30 to 40%. And do you have time for it to recoup and all those things? Because, I mean, we have that last decade of 2000, 2013, you made no money in the stock market. And if you were taking 3, 4, 5% withdrawals, you're running out of money. But the fact is that you have no control over the ups and downs and the valuations and the volatility of the stock market. You can't control that. But you know what you can control? And this is where it gets insane. You can actually control your tax bill. Believe it or not, taxes are an option for you, right? And I'm not saying avoid taxes. I'm not saying go to jail for your taxes. But what I'm saying is that just like you arrange your affairs with your income and arrange your affairs with the stock market money, and you allocate accordingly to take the risk you want to do, you can also allocate correctly to make sure you're paying the least amount of taxes possible. We had this doctor come in. He's a dentist. He came in with his wife, and they have this huge dental practice out here in Anne Arundel County. And they sat down with us, and they had heard us on the radio, and they had heard us talk about the fact that they could sell their business, because that's exactly what we're talking about here. How do you sell your business and control the taxes? And what he had done is he had sat down with his CPA, who'd been doing his taxes for years. They ran the numbers, and the CPA basically said, you're going to stroke a check to the federal government for about $1 million, and you're going to stroke a check to Uncle Sam here in the local Uncle Sam here in Maryland for about $900,000, and you're going to call it a day. And you know, the $900,000, you don't even get to write it off your tax return anymore. You're just hosed. And he did not like the idea of losing all this money. First of all, this was his nest egg. It was the biggest nest egg he had, because for those of us that own businesses, yes, we put money away into accounts, but frequently the value of our business is half of our retirement, or even more for some of us. So what we did is we sat down with him and we said, look, you own your building and you own the practice itself. What happens if we split the sale into two aspects? We split it into two parts. What happens, because they need income during retirement, what happens if we take the building part of it and we do a certain type of tax transaction? It's going to yield you 3 or 4%. So we're going to call that our, and I'm doing air quotes for you on the radio just so you can see the air quotes, the safe money. We're going to make that our safe money. And it's going to produce, 3, 4%, maybe 5% in a good year for you. And about 50% of it's going to be tax-free to you each and every year. Right. So that gave them some of the income they needed. It was coming out in a very tax efficient manner. But the practice itself, that's where the biggest bang for the buck was going to come. But they didn't need all $3 million from the sale of this practice on Tuesday. It wasn't like they were going to go buy something for $3 million. That was going to be used for the income. But the problem is they were going to have to pay capital gains on the whole transaction today. So what we said is, what happens if we set up a very specific type of trust and we transfer the practice, not the building, but the practice into the trust. And then we sell the practice to the people who are buying it, the other dental firm. And it's one of those big dental firms that buy smaller guys up from all over the country. And so the purpose of doing that is, it's not that we're going to eliminate your tax bill forever, although with certain strategies, you might be able to postpone it for several generations. But what we were able to do is say that, look, when you need $50,000 out of this account, out of this transaction, when you actually need to spend $50,000, you're going to take $50,000 out and you're going to pay capital gains on it at that time. And what that allowed us to do, and this is what Ryan was saying before, what it allowed us to do is we could take enough money out of the trust and taxed at the proper tax level so that they were paying 0% taxes on that. What it also allowed was, because we're going to pay 0% tax on that, it meant that their Social Security wasn't going to be taxable. And when their Social Security wasn't going to be taxable, even though we were taking money out of their IRA, it was at a low enough that their standard deduction offset the distributions. So these guys are in the $110,000 to $120,000 a year income range, paying zero taxes. And that's why I said at the onset that we get to control our tax bill. It's one of the few things that you can actually control during retirement, because you can't control whether the market's going to go up or down. You cannot control that. Yes, you can control how much risk you want to take, and you can take all the risk off the table by buying insurance products or buying CDs, and you've transferred the risk to those guys. But the fact is that you have 100% control of your tax bill every year, but you can't do it on April 14th when you sit down with your CPA or whoever it is. Tax planning is exactly that. It's planning, and it's an ongoing process. We sit down with our clients 2 and 3 times a year. When we create the plan, it's hours and hours and hours of creating a tax plan. And then every year it takes 2 to 5 hours every year of monitoring and tweaking it to make sure that you're always in the lowest tax bracket possible. And if you want that experience, if you want to truly understand how to divest yourself out of basically, I mean, this is your labor of love. You have created this incredible business. And now these clowns, these guys are horrible stewards with their money. They want to take 20, 30, 40% of your money right off the top. That's insane. You shouldn't be doing it with your investments. And you certainly shouldn't do it with something that we're so passionate about and you loved. You put so much of your energy into it. It makes no sense to give them 30% or more when you sell that business.
TheSavvyInvestorRadio.com, TheSavvyInvestorRadio.com, and click on the tax analysis button. I'm looking at it right now. It's right there in the front page. Tax planning analysis button. You can do that. What's that going to do for you? Well, that's going to instantly take you to a Calendly page, and that's going to have Mike, Ryan, Lawrence, the entire team's schedule on that Calendly page. And then you have control. As Mike was talking about having control with your taxes, you have control of your schedule, of your calendar there on when you can meet with them. And that gives you a quick 15-minute phone conversation to get things started on that tax journey to become as tax efficient as possible. Guys, thanks again for being here as you guys do each and every week on the radio show, on the podcast, on the YouTube. But as always, got to wrap things up. Make sure to like, subscribe, and to share with your friends as well. You guys always get the final word. Thank you very much.
This is Ryan Herbert. Thank you so much for listening to the Savvy Investor Radio and podcast.
This is Mike Kinnett. We'll see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.